Hi there, this is Vinney Chopra. Good morning, or good afternoon, or good evening. I don't know when you are listening to me, but as you know, I come live, or not live, on the podcast, and many times we do broadcast live also. I have a great guest today. You're going to love him, love him. And the good part is, guys, please do subscribe, like, comment, and share these episodes all with your friends because I try to bring really, really great content for you. Again, I live near San Francisco. You can see in the background, my buddy Yonah also is right here. No, not in San Francisco, it's virtually. Yonah, how are you? Good morning.
Yeah, doing great. It's a beautiful day out there over the Golden Gate Bridge. And I'm just happy to be here with you, Vinney. You know, we did this together a couple of weeks ago on my podcast, and I'd love to share some of my knowledge with your audience.
Thank you so much. It's such a pleasure, guys. Remember, Syndication Made Easy is the podcast, and as you know, I wrote that book, and I just thought that maybe I can bring more value to my investors, to my students and everybody. That's why I do it. I love it, what I do. I would like to introduce actually Yonah very nicely. Formally, Yonah is a powerhouse with property owners' tax savings. Hey, taxes. When we talk about taxes, and if you can save them, that is the name of the game. As business director at Madison Specs, a national cost segregation leader, he has assisted clients in savings tens of millions of dollars on taxes through cost segregation. He has a background in teaching, which I love it. He simplifies things, He's come on my mastermind inner circle coaching also. I really appreciate you, Yonah. And otherwise, also you've come on other shows. And a passion for real estate and helping others. He's a real estate investor himself and host of the new podcast, Weiss Advice. So please, Weiss or Weiss?
Weiss.
It
rhymes.
Sorry.
Weiss Advice.
Yonah Weiss. That's YONAH and Weiss, WEISS. Weiss Advice. Welcome, Yonah. It's such a pleasure, buddy. I enjoyed meeting you in, I think, Orlando. Remember? When we met,
it seems like ages ago.
And Grant Cardone passes by. Oh my gosh, that was something. No, welcome. Wanted to kind of give a little bit more background, how you got into this field, but then we'll drop nuggets, golden nuggets left and right for our audience, right? Yeah.
Absolutely, Vinney. Thank you so much for having me. A little bit of background, I guess you would say, like you mentioned, I was a teacher for many years, and I continue to be a teacher. I have 6 kids, and so I'm always teaching them. And I love just sharing whatever I have to know, whatever I've learned in my experiences, whatever that is, just with other people. And this kind of topic of cost segregation, that currently that's what I'm doing. Okay, I work for, like you said, Madison Specs, the biggest national company doing it. And I'm able to really educate people because it's a subject that is kind of shadowed by a lot of confusion. People don't know what it is. First of all, they're thrown off by the name, right? Yeah. What is this? We're in 2020. You're talking about segregation. We don't want anything to do with it. And besides for that, it's taxes. And I think a lot of people have kind of an aversion to taxes, and they think taxes are something that my accountant takes care of. And most people, you for sure have a lot of proactive people that want to do their own taxes and they want to look at it. But the majority of people, I think, have kind of ingrained into them 2 things. One, I don't deal with taxes. Like, that's my accountant does that, and I don't even know what this. So if it has something to do with taxes, probably my accountant would have told me about it, or else, right? Or else, like, why wasn't I paying them all this money? The second thing is that when it comes to taxes, especially if you're working in corporate America, you're used to your taxes being taken out of your paycheck before you even see it, before you see any of that money. Yeah. So when it comes to real estate and what you're doing, and I think a lot of your listeners are into real estate or looking to get into real estate, it's one of those paths where the income you're producing from real estate is not taxed. It's not deducted from any paychecks, right? It's your money. And there are so many tax incentives like depreciation and cost segregation, which is really just an advanced form of depreciation we're going to talk about today, that people don't understand that you now can take more expenses and more deductions than you even have income. And so all of that income has a chance to stay in your pocket, reinvest it, use it, and use that to grow wealth, as opposed to just having the government take it away from you, thinking that it wasn't mine in the first place, it belonged to the government. That's not true. It's your money. You have to be proactive with how to make sure you keep the most of it.
I'm so glad you said that. You're so right. People are so afraid of two things happening: death and paying taxes. Hey, we should be okay with the death. If we are living life to the fullest, I believe that, that we should be ready to die tomorrow. But take care of the revocable trust, take care of family, take care of children, everything, right? We want to make sure all that is taken care of. It's so important. But you're right, taxes, especially in USA, and then let's go to other countries too. Same thing, Canada, Australia, everywhere. I mean, they are taxed to the hilt. We are taxed over here too. Sales tax, property tax, income tax. Of course, we talk about LLC tax, right? The corporation tax, death tax, inheritance tax. I mean, you name it. So let's make a big dent into this cost segregation. So you're right. It's the line item, depreciation straight line. Would you kind of explain simpler terms, just like you're teaching, right? Somebody. So please, explain how you are able to save millions of dollars. Yeah.
Absolutely. Right. The first thing we have to understand is what is depreciation. And like you said, it's a line item. It's a deduction in your taxes, but it's pretty simply to understand it. When you buy a property, besides for your personal residence, any type of property, business property, investment property, whatever it is, you now are allowed to take the entire value of that property as a tax write-off. Okay. This is called depreciation. And it's based on the concept that things go down in value as time goes on. So the IRS wants to incentivize you and says, okay, it's going down in value every year. We're going to give you a deduction a little bit every year, right? For a 27.5-year period for residential properties or a 39-year period for commercial properties. So we're going to give you a little bit of a deduction to kind of offset that loss, offset the fact that your property is going down in value. But like I said, it's just it's based on that principle, but it's not really true because real estate is usually inherently going up in value. It's appreciating as time goes on.
Correct. Yep.
But so they say, here's this depreciation deduction. And the reason why I say it's also kind of just based on the fact it's more hypothetical than anything else is because it starts, that schedule, that 27 years or 39 years starts the day that you buy a property. Or if you're doing new construction, the day it's placed in service. Now, for new construction, it makes a lot of sense, right? It's brand new. Now it has a useful life, has a life of 27 years, right? Makes sense. But if you're buying a used property, right, a building that was built in 1924, and you're buying it today, it's lost its value theoretically. But no, the government says, no, now you can start over from new in 27 years again and start the schedule now. So that's why I say it's kind of based on that, but it's not intrinsically about something going down in value. That's depreciation. And like I said before, cost segregation is really just an advanced form of that, because what a cost segregation study does is the IRS requires an engineer to actually break down the building from a construction standpoint and say, not new construction per se, but even an acquisition. How much is every single item, an asset inside the property and outside the property? How much is that actually worth on its own? Yeah. And then all of those things have a different depreciation schedule, and many of them a much shorter life. So things that depreciate on a 5-year schedule or 7 or 15-year schedule, that you can identify what those things are, accelerate that depreciation to take those deductions, the value of those items at a faster rate. So increasing deductions early on.
Totally. And again, the land, we take it out, right, from the purchase price, because land does not depreciate. Dirt is dirt, right? I mean, it may go in value, of course, actually, because if the neighborhood gets improved, gentrifying, all that, or a lot more new jobs coming in, right, the land value will increase. But that's assessors, right? And so forth, assessment. So the structure, could you kind of explain in simple terms, like what's on the 5-year, 7-year, 15, and so on year schedule?
Absolutely. So yeah, the main structure of the building is what's going to be on that longer schedule, the 27.5 or 39-year schedule. But inside the building, if you're looking at anything in a property that's not structural, so structural things would include the roof, the walls, windows, doors, main plumbing, main electric, and that's about it. Okay, there's some other stuff, maybe foundational stuff, but everything else is essentially what's considered 5-year property. It depreciates on a 5-year schedule, considered personal or tangible property. So think about stuff like furniture, okay, equipment, appliances. If you're building a kitchen, you have an apartment building, you have countertops and cabinets, all that stuff depreciates on a 5-year schedule. Okay, even stuff like the blinds and curtains on your windows, or fixtures and wiring and your security cameras, all that stuff, and much more. So all these things, we're going to identify what they are, what's the value of those things, amidst the purchase price, and then it can be in multifamily properties, upwards of 20% of that value of the purchase price, and literally take that as a deduction, as an accelerated. So then you have things like 7-year property is much less. It has to do more with when you have a property where there's an owner operator involved. So it happens a lot more with office or industrial, and things that should be 5 years are put on a 7-year schedule because it's owner operated. There's certain things like cable wiring, which is much more common, or intercom systems, much more common in office buildings. Again, those are on a 7-year schedule. So there's very few and far between in that. 15-year schedule is a huge thing. Now you mentioned land doesn't depreciate, right? And land, you have to separate a certain amount from the purchase price to allocate to land value. In San Francisco, right? I'm looking behind you, right? Those land values are really
big
high.
value.
Unfortunately, right, in California and San Francisco especially, in places like that, the land value can actually be upwards of 60%, which is crazy. Which is going to diminish your depreciation amount. It's going to diminish the amount that you can actually take as a tax write-off, because you don't get any of that land value. However, there's something called land improvements. Which is anything that's on top of the land. Now, the land is dirt, but what's ever on top of that dirt, like pavement, okay, if you put a parking lot, or even, the bollards in the parking lot, all that stuff, fencing, anything outside the building, landscaping, you have beautiful landscaping, bushes and trees and flowers and all that, signage or retaining walls, anything outside the building, it's not land, it's land improvements. And that stuff has a 15-year life and has a lot of value to it.
15-year, Marvelous, 15 years. And the rest will be then whatever is left behind will go on 27.5-year schedule on residential, like multifamily, that's residential, even though it's commercial, but it counts as residential. And then, of course, the office buildings and hotels and things like that, right? They go into the rest of the 39 years, actually. That's the other commercial, right? What's this bonus? 179 bonus depreciation, which is in hotels. As you know, I bought that Hilton Garden Inn in Texas. We are buying Marriott Courtyard. So I've branched out now into hospitality, into senior living. We'll talk about a little bit about that too. And then multifamily, So we are discussing multifamily right now, right? So any other deductions are possible, and what kind of costs are involved and so forth, if you want to share? I know it depends on,
Absolutely. For sure. There's actually there's two different things. There's something called 100% bonus depreciation, which is a new law that passed a couple of years ago with the tax reform. And then there's something called 179 deduction, which they're two separate things. They're similar, very similar. They have different rules that apply to them. But the 179 deduction is really allocated to equipment and new things that are in a commercial property, not a residential, specifically commercial. So that's why it will come in a hotel or an office or something like that, where you'll have equipment and you'll have certain types of furnishings that you can take as a first year, 100% of that as a first year expense. it's different because it's not depreciated. So it's just like a write-off. It's an expense. You spent the money. Now you can, you put in something new, and it's specifically with new things. So it's not like when you buy a property, well, it's depreciated, and you can do the accelerated depreciation and the bonus depreciation, like I'll touch on in a second. That's when you buy an old property. But when you're developing a new building, you may have the 179 deduction because that's spent on things that are actually brand new.
Got it.
And there's also limitations to how much you can actually take per item on the 179 deduction. So I think it's like $1 million limitation on that. Whereas the bonus depreciation says that anything that depreciates on a faster schedule, faster life than 20 years. So all the stuff we just described in cost segregation, you get that cost segregation study done. You now identify stuff, personal property on a 5-year schedule, land improvements, 15-year schedule. You can now, instead of just accelerating that to those faster schedules, 100% bonus depreciation says you can choose to take all of that in the first year as a first-year write-off. So there's no limitation. Okay, and that's where some of the confusion comes in, because 179, there is limitations. Bonus depreciation, no limitation. You can literally take the entire amount of accelerated depreciation as a first-year tax write-off.
Wow.
Which is huge.
It's huge. No, totally. I know in the $50 million deal, actually I'm going to definitely my senior living and all these, you're going to be my consultant and working with my companies, all these expansions, hotel also, it's yours, to
senior
do
living
and everything.
Senior living has a lot more than other types of multifamily properties, because as you know, I mean, besides for, you guys are making like luxurious senior living. So you're having beautiful landscaping and all that kind of stuff. But even in the properties, as opposed to, it seems like on the outside, it looks like a hotel or a multifamily property similar, but on the inside, you're going to have like really special equipment or really special beds, all of those appliances and things like that are individual in each room, right? You may have a kitchenettes in each room. You may have,
we do have.
You may have single air conditioning units in each room.
Yes.
And so those are huge expenses. It's going to be a lot more depreciation than a regular multifamily building will have.
Oh, I'm so glad you said it about senior year, right? We also put movie theaters in there, spas, salons, private dining halls and all that. You're right. So it's just like a luxurious, lot of nice chandeliers, of course, furniture. We like to really do the code. Color coding, all that, 2-tone, 3-tone like that for our seniors, because our motto is let's spoil the generation that spoiled us, and
That's
we are
nice.
very fortunate for that. But you're right. So in the multifamily, is there anything else we might have missed, you think? Let's see.
In multifamily, there, in terms of, I'd love to get into, kind of understanding how it works and what are the mechanics and how to go about doing it. But in terms of the actual property, people think it's really complicated. And I like to simplify it as much as possible, because
I like it.
There's not.
It's the best.
It's something that a lot of accountants don't even understand, and a lot of accountants don't do. And the reason for that is very simple. It's one little tiny section of the tax code, and it's, if your accountant's not a real estate, focused accountant, they may never have heard of it. Okay. Because the whole tax code is huge, it's massive. No one can be a specialist in every single area of the tax code. You have specialists in each area. Similar to, a doctor. You don't have a general practitioner. He may not know of everything that's out there. He may have heard of it and he'll refer you to someone else to talk to about. But same thing with taxes. And the other reason is simply because it requires the engineering component, and it's something that accountants can't do. Right? The study is done by engineers. It's not done by accountants. Therefore, it's reviewed by accountants. We have accountants on our team that review everything, and create those, the principles that we run it by. But if an accountant can't do it, then he doesn't really want to have to deal with it. So he doesn't even think about it.
No, so right about it. I was going to say again to the audience is that, as we do the taxes in the LLC that buys the property, it's a pass-through entity. We call it, it's a pass-through entity. We don't pay taxes in that. So by running all the income, expenses, and NOI, the net income, there is that one line, depreciation and auxiliary depreciation, that makes the whole property go upside down.
Yeah.
I mean, we got like how much? $7 million deducted, I think, out of this one property. And then 5 million something got deducted is another one. My investors who gave me 500,000, they got a K1 of minus 319,000.
Yeah.
They couldn't believe it.
Crazy.
They said, what in the heck?
Yeah, it's important you brought that up. It's pass through. So whoever invests, whatever shares they have in that, they're going to get their percentage of depreciation.
Yes.
And there's really no other investment vehicle that I know of that you get a return on your investment and it's tax-free, right? Or at least temporarily tax-free. I mean, you may have to pay some of it down the line potentially, but right now it's crazy. So yeah, you invest $500,000 and you get your return on investment plus that whatever that return is not taxable.
Right, like minus 61 then, right? If we break it down, 500 is 300 something. So if we divide that, you're right. I mean, and some of these properties, and the good part is if you close before December 31st, you get the deduction for the whole year.
Yeah.
Isn't that awesome? Yeah.
Crazy.
So it's a wonderful thing. Let me kind of ask you then, share with you, like your company, it's pretty big and, please toot your horn, if you will. Tell us, the scope and everything, because, it's good to work with great professionals who care and who can provide you the knowledge and also work with you, and build that relationship, right? So please,
There's, Madison Specs. So we're actually one company as part of like a greater umbrella organization called Madison Commercial Real Estate Services. So we're actually not an accounting firm. Okay. We are a commercial real estate servicing company at its hub, which our main company started with title insurance. So we're one of the largest national commercial title agents, dealing upwards of 10 to 15,000 transactions a year. So that's really where we started, kind of branched off. We have Madison 1031, which is a 1031 qualified intermediary company. We have, the Specs, which is the Cost Segregation company.
Yes.
Due diligence and lease abstracting, CAM auditing. These are other kind of ancillary services for commercial real estate. But Specs started off about 15 years ago from a couple, one engineer and one accountant.
Wow.
That came on board, that they were working together at one of the largest national accounting firms, running the Cost Segregation Study department at that accounting firm, and decided that they're going to open up a shop on their own. Started Madison Specs, and literally with nothing. They have like a couple of clients and nothing. It's grown to now, as we're 15 years later, we've done over 16,000 studies. All 50 states, helped over $3 billion of tax savings for our clients.
Wait a minute. 3 billion, guys. Please listen to that one. 3 billion. Wow. Awesome. Congratulations.
And we work on all property sizes and types and shapes and forms. So whether it's a small, single family, or if it's a large skyscraper, okay? Yeah. If it's a commercial property, we can do it. So, we did one of the largest, in fact, in San Francisco, there's a very large commercial property, a multifamily property called Park Merced. You may have heard of it. It's right next to San Francisco State University.
Oh,
it's a big, it's about, apartment complexes, high risers, about like, each one is like about 12, 15 stories high. And there's probably like 30 of these buildings, like this huge kind of community. Sure. I think over 4,000 units altogether, right? Wow. And so one of our clients, bought that a number of years ago. We did the cost segregation. It was like a $2 billion deal, right?
Wow.
It was a big property. And like I said, anything, any type, whether it's industrial, distribution centers, retail, shopping centers, self-storage, mobile home parks, name it, everything and anything. And we have a huge team, 16 engineers and a whole team of accountants, whole operations team. And we're just, I'm out there just spreading the word, just trying to help people understand it a little better so that they can, take hold of their finances.
Sure. Wonderful. Actually, you just mentioned about $2 billion worth of, San Francisco properties, right? At these skyscrapers. Just kind of being from India, right? I just thought about an industrialist. His name is Mukesh Ambani. I'm not going to, he's got personal residence, $2 billion in Bombay, India. Out of anywhere else in a developing country, he's got very big industrial companies and all that. But anyway, 6 stories are just the parking, spaces, right? And then it's like 42 stories long. That's his house, Anyway, so cost segregation on that would be quite amazing.
What's amazing is that you can actually, again, that's if it's a personal residence, it probably doesn't apply, but it's probably a commercial property also in a sense. Yeah. But you can actually do cost segregation on properties outside of the United States.
Oh, yeah.
As long as you're a U.S. taxpayer and you are paying U.S. taxes, but you own real estate overseas, you can do the cost segregation study on those holdings.
Fabulous. That's good to know that.
Yeah,
I didn't
there's some different there's different rules that apply to it a little bit. There's like a different schedule instead of it's called the ADS, an alternative depreciation schedule system, which puts things instead of 39 years, it's 40 years instead of 27 years, it's 30 years, things like that. But there's still a lot of advantage to be had.
Beautiful. Hey, let's just tell us a little bit what's to expect from Yonah Weiss. How does your day go? And tell us something about family and the things that you're doing and all that, because that's very meaningful, to get to know and so forth.
Yeah. I'm a very religious person. I'm Orthodox Jewish, and I'm very spiritual. You may not be able to tell, but I spend a lot of time. So the first thing I do when I wake up in the morning is I spend, the first words out of my mouth are words of prayer. Okay. I don't talk to anyone. It's just really focusing on God and focusing on spirituality for at least the first 2 hours of the day. So that's something that is, without change, always happening. And I study. So I spend a lot of time, and I spent really about, 15 years or so when I was teaching, full-time studying and teaching. So literally like around the clock, just involved in depth and very deep spiritual metaphysics. It really is what it was.
That's awesome.
Yeah. So it's like I have like in a way, it's sort of like a doctoral, a law degree, like all these advanced degrees in the Jewish texts and studies and things like that. So that's really a big part of my life. Family, like I said, I have 6 kids, so I like to spend a lot of time with them as well, which, is hard.
How old is your oldest, by the way?
My oldest is going to be 16 next month.
Oh, awesome.
So she's our oldest, and then I have kind of each one, they're about 2 years apart or so, give or take. And my youngest is 5 right now. And
beautiful.
But love them.
You're blessed. That's awesome.
Very blessed. And work is something special. What I do, a lot of stuff I do is really remote, right? Because I'm on webinars. You're in San Francisco, I'm on webinars and podcasts, and I'm on social media a lot. I spend a lot of time on social media.
Totally.
So LinkedIn, especially, because there's so much networking opportunities, so many people you can help, so many people you can be in touch with. And I've just found, they say like your network is your net worth, right?
Totally.
The more people that you can connect with and reach out to and speak with and then develop relationships with, the more worth your life has, the more opportunities come your way.
You're adding value. You're adding value to everybody you come in touch with. Yeah. And it's amazing. More you give, more comes back to you. I know we have always built in that, and thank you for sharing. I'm very similar like you. When I get up early, 5 o'clock, 5:30, I'm also chanting and doing reciting and all. I'm very religious. Actually, I used to be very thin. So I worship the God of strength. Hanumanji, we call him, and he's the one who actually carried the mountain on his one palm. He needed to bring some kind of medicine plant or something. in one of our stories, and he couldn't figure out which plant, so he just took the mountain on his hand, palm, and brought it. But no, that's so important. And I think you also mentioned a few weeks back that how the young people, the youth, they have to learn the
Yeah.
ethics and the trust, and right, that share that again, that really caught my attention. In our Vedas
Yeah.
also it says that.
Absolutely. It's yeah, I mean, it's really something, our tradition goes back thousands of years, and it's, we teach our children,
Yeah,
one of the most important things to us is, our dealings among people. So how
yeah,
we treat other people, and how we, especially business dealings, how honest things have to be, weights and measures, there have to be so honest and do this. So one of the things we teach, our children at the youngest age is how to watch other people's property, right?
yes,
How to
yes,
deal with what happens if you find a lost object. You have to
yeah,
return that. You have to try to find the owner. And there's a lot of rules and laws and things that are just kind of way of life that are kind of part of us. So these are like the first things we teach small children when they're at that age, not tiny children, but 6, 7, 8 years old. This is what they're studying in school. They're studying about how to relate with other people, how to treat other people.
yeah. So true, so very true. The success principles, I think the biggest thing is the foundation. Just like the higher the building will be, or what monument, and everything, it's the foundation that will really
Mm-hmm.
build us. I know our two children, Neil and Monica, we are very, very proud of them. And of course, Neil went to Berkeley and computer science and electrical, and Monica went to UCLA. She's fully engrossed in our business now, so it's
Oh,
a
wow.
family business. I really want to thank you for taking the time, bud. Oh my gosh. What other things, you might like to share with somebody who's just starting out, maybe investors and who are purchasing property? How many units it has to be, maybe to make it cost effective, if I may ask you that, right?
Yeah, it's more about the purchase price than the unit count. So
Yes.
if you buy anything for over $500,000, there's
Yes.
really a tremendous amount of benefit there. And the more the purchase price is, the more benefit there is. And one of the things that we do is we'll provide a free analysis.
Oh,
Okay, so
lovely.
you can
Wow.
reach out to us, and any property you have, even if
Yeah.
you're in the due diligence stage, you haven't even bought the property yet, but you're looking at it and you're thinking, well, if I do a cost segregation study, what's going to be my tax benefit on this as well? It's a
Sure.
good thing to kind of share with, to know what your business plan is. We'll do that upfront. So you'll be able to tell right away what your potential
I
tax savings
love
are going to
that.
be.
Excellent. Excellent. Beautiful. And how can audience reach you, bud? Yeah.
You can find me on LinkedIn. That's the best place. You can also go to yonahweiss.com.
Okay. Yes.
And you can actually, there's a link there. You can actually fill out a form to get a free analysis on that. So check that
Beautiful,
out.
beautiful, beautiful. Yonah, thank you so much for taking the time, buddy. I really respect you and who you are, and what a great person you are as, and also business professional. I really want to thank you today for joining me, and also all our audiences. Your circle and my circle. Please do, and Yonah just started the podcast, so please download and look at every week's content. He's bringing some great, great guests on it. So I hope that that you do very well. I wish you all the best. And also to my audiences, again, please follow me on LinkedIn, Instagram, Facebook, and my new book is coming out on positivity brings profitability. My third book is almost ready, which is investing in senior living. My fourth book will be The Lending Made Easy with my partner also. So I'm coming out with 4 books, just to let you know. And if you like, the content of what I bring and my team brings out to you, please like, subscribe, and also comment below so that you can really spread the word and share it across with your friends. And also give us a 5-star review if you think the content is good on the iTunes, because that will rise us up, in the rankings, and then we can bring some really great more content to all of you. So if you'd like to reach me and my team, heard benefits of owning, investing in real estate, reach out to us. Our line is always open to see who can we help you and achieve your goals. You can visit vinnychopra.com/success strategy call. So that's the link. You could just go vinnychopra.com/stress. Oh boy, I can't even speak. Success strategy call. And then if you would like to invest with us, please visit vinnychopra.com/invest. Don't forget to like, subscribe, comment, and share this episode if you found value in it, and if you think someone who might also find value. So thanks again, and look forward to see you next week. Thank you so much. Bye-bye.